Hi everyone, and welcome to Trading and Investing in the US markets. Now, during this training, we'll set the framework for what will form the future of your market investing or trading. Now, these are the lessons that my mentor taught me more than 20 years ago, and which are even more valid today. Now, I'm excited you've decided to join me, and I know you're going to get a lot out of this presentation. I'll be jumping between the presentation and a trading platform to help explain some of these topics. So bear with me during those transition periods. Okay, so let's get started into the presentation. Okay, so today we'll discuss trading and investing in the US markets. Knowing how to read the markets is the first skill you need to learn to gain consistency in results. Now, I've spent my career honing and practicing techniques and methods that you'll need to make clear and concise decisions. So through this webinar, I'm going to give you the key lessons from what I've learned in 20 years in the markets. Now, I'm confident what I discuss today will shape how you approach the markets for the rest of your life. But before we begin, I have to do my due diligence. Any stock or investment position we discuss during this webinar is not to be considered as advice or a recommendation. You should seek independent financial advice before acting on any information. Okay, so what you're experiencing now as you dive into trading or investing in the stock market is what hundreds of thousands of people have gone through before. It's an emotional roller coaster ride. How you manage those emotions will be the key to your success. So the first thing I want to do is frame your mindset towards the stock market. Now, I don't need to convince you that the US markets offer some of the most amazing opportunities in the world. And whether that's you wanting to invest for the long term or whether you're looking to make gains on the short term. So here are 5 tips to succeeding in the stock market. First of all, don't overthink it. Too often people are paralyzed by the amount of information that is out there. They'll spend countless hours reading these articles, listening to that blog, watching these videos. It can become quite overwhelming. So the first thing is that you don't want to overthink what you're doing. Certainly you need to have an understanding and knowledge of what to use, how to analyze, how to choose stocks, but you don't want to overthink it. You can get paralysis by analysis in that case. Second of all, markets or economies are geared for growth. Now, I'm going to show you a little later on a history of the stock market. Now, I don't want to focus in on that, but here's the key thing. The markets or the economies are geared towards growth. They are continually expanding. And with that in the back of your mind, this is what we're here to do, is we're here to make money from stocks gaining in value. The old saying of buy low and sell high just comes down to how do you choose something that you can buy low, then sell high. But if you've got the mindset that the economies are geared towards growth, then you'll have the basis for what you're going to be doing in the future. But hold on, I might hear you say, Matt, the stock market crashes, I'm afraid the markets might decline, there might be another GFC, for example. And yes, fear and greed will always be present in the markets. And that brings me to the next point, in that a major market downturn will occur in your lifetime. Now, the frequency of these major market downturns is a little bit more frequent than it has been historically. And when I say historically, I mean over the last 100 years. But the markets grow, economies change, trade balances between countries, technology has completely changed the environment that we're dealing with now, even from when I started 20 years ago. Finally, it does take practice to control your emotions towards making and losing money in the markets. And it's not that you take out all emotion towards what you're doing, becoming a robot in your emotional state. You can still get excited about positions, and you can also still be a little bit fearful towards what might go on with a particular position that you're holding. But there are a number of factors around how we manage what we do in the markets that assist us in controlling that emotional state. So your decision making needs to be based on analytics and experience and not emotions. Now, I thought what I might do is just quickly touch on a couple of the key things that I've experienced in my trading career. Now, I've experienced the excitement and the fear of making my first trade. We all had to start somewhere. My first trade back in 1998 was on a small New Zealand company. I say small, it was big for New Zealand, but it was small compared to the rest of the world. Now, as an Australian trading on the New Zealand market, that's not quite heard of. It's not the common practice. But my first trade was on a New Zealand stock. I can't remember how much money it was. I can't even remember the details. I think it was one of the Fletcher companies. I ended up making a few $100s. Of course, at this point in time, I'm now bitten by the bug, right? So I've now spent a 20-year career expanding into the biggest market in the world with the US stocks and options. It's something that I guess is a topic for another time. But in terms of what I do now, the principles that I was taught by my mentor still ring true today, and I still use those and teach those today. I've also experienced quite a number of bull and bear markets. The first bear market that I experienced was the 2000 tech crash, and that taught me a lot of lessons. Here I was, a relatively young trader, somewhat bulletproof because I'd had a few years of exceptional returns, and then this crash occurred. And it taught me some very valid lessons that helped me through even bigger market corrections such as the GFC in 2008. Now, I mentioned market crashes. They've occurred in the past. They're going to occur again in the future. How you approach your management of your portfolio and positions, your mindset, is one of the biggest key things that I've experienced in my 20 years in the markets. And this is what I try and spend as much time on, is conditioning our mindset towards how we view the markets. I've also experienced confusion and frustration, seeing positions decline when there isn't a particular reason for it. You learn to detach yourself from that, and if something's shifting against you that doesn't make sense, then we need to just act on that. You can't sit there and procrastinate on a position. And I'm talking long-term as well as short-term. You don't want to have to ride through a long-term decline in a stock and try and recover at some stage in the future. You never know if a company's going to turn into a WorldCom, for example, and delist from the markets. Finally, I've also experienced the rewards, of course. I've got confidence in what I do, elation of making a profitable trade, or more so, the elation of having a trading plan, an approach, a methodology, sticking to it and trading that successfully. Because if it's a successful trading approach, then the profitability will come off the back end of that. So the focus is what you're doing, not what are the results. The results are the confirmation of what you are doing. And I believe I have a profound understanding of the markets. And this is why I love the markets so much. It's just something that's now part of my DNA. So when it comes to making money in the markets, there is more than one way to crack an egg. Here I'm talking analytics. And there are 4 real key analytical approaches. There's technical analysis, fundamental analysis, economic analysis, and quantitative analysis. For the most part, nearly all beginners are really focused on the technical side of things. It's charting. And this is where we're looking at price movement up and down. Fundamental analysis represents the numbers of the company. What is the performance of the company? Now here's the thing, fundamental analysis is representative of longer term decision making. And just because there's good fundamental analysis of a company doesn't necessarily mean that it's going up in value in the stock market. The influences of sentiment, that is buyers and sellers and their opinion of what's going on, the influence of industry, another company may have made some sort of announcement and that then affects a company that you're on. So marrying the two, technical and fundamental analysis together, in my opinion, is a very sound approach to decision making. Now, economic analysis is also very important. A lot of people forget to take into account the economic side of it. So with economics, what it's doing is it's painting the background of your picture. It's telling you what sort of environment you're currently in. In just a moment, I'm just going to take you to a website where you can grab that information for free and start to form your own opinion. Finally, quantitative analysis is something that's a little bit hard for the average mum and dad to do at home on their own. So this is where I'll subscribe to services such as Standard & Poor's or Morningstar, for example, where they have teams of analysts that put together quantitative analysis. And that way I can start to form my opinions based on information gathered by someone else, a trusted source, and then I use my own analytics to make my final decisions. So let's just jump in and take a look at a couple of points or a couple of places where you can get this sort of information. So here we have a chart of the S&P 500 index. This is where we get our technical analysis. This is a chart that represents 1 year in time. Now, on the right-hand side, we have the scale. It's an index, so it's not a dollar value, it's just a point value. Now, the S&P 500 index is a representation of the top 500 companies on the US market. So it's what we would refer to as a benchmark. Okay, so what we have on screen here is Japanese candlesticks, and that's a price analytical technique. And what it does represents the open, the close, the high, and the low of whatever period we're defining. And in this particular case, we're talking daily candles. I won't go too much further into them at this stage. It's literally a complete lesson in its own right. But suffice it to say that green candles or upwards movement represents the price increasing. Red candles represents downwards movement or the price is declining. On this chart, I also have a couple of other techniques. Volatility, I'm going to discuss volatility in a second. And I've just got some a very simple analytical technique called moving averages. And I have two moving averages here. One, the blue line, is a 50-period moving average, and the green line is a 100-period moving average. They represent the average price over time, and they follow the particular price movement. So the S&P 500 index is a benchmark to the US markets, and as we scroll back in time, we can see that the price has increased. So this is what I was saying before, is that over time, markets increase in value. And we can see even, I've just scrolled back to 2015, that through that time frame, the markets have increased, just say on average, about 35%. That's not peak to trough, that's literally just the main crust of the upwards movement. Of course, there are some declining movements in between. Now, there are many different analytical techniques with technical analysis, and all methodologies work. This is the thing about technical analysis. They will all work, but they don't all work at the same time. And one methodology might be looking for one type of change in the markets or a movement in the markets or trying to define a particular strategy that helps for long-term or short-term, for example. And another technique will be looking at something else. So one of the things with technical analysis is that you can choose a methodology that you understand, that you like the idea behind, and stick to that. To give you an idea, I'm a Dow theorist. You may have heard of the Dow Jones Industrial Average. The gentleman who came up with trend theory or trend analysis in the early 1900s is a gentleman called Charles Dow. Charles Dow was the first editor of the Wall Street Journal, and he developed this simple methodology of trends. So the key to technical analysis is that it is reviewing or analyzing market sentiment. These prices here represent everything in the markets. Buyers, sellers, institutions, mums and dads, professionals, hacks, just everybody is represented in these prices. So when we're analyzing using technical analysis, what we're doing is we're analyzing the sentiment. We're analyzing buyers and sellers and their reaction to the fundamental and economic news. Now, technical analysis is typically used for short-term trading. I mentioned that before. We can use it for long-term investing as well. And so you don't want to mix up your techniques based on what your strategy approach is. you could be making poor decisions if that's the case. So there's a little bit to technical analysis, but it's typically the easiest methodology for someone to learn. Next, we had fundamental analysis. So what I want to do is I want to show you simply some fundamental analysis. So what I've done is I've come to finance.yahoo.com, and it's just a news website. And what I love about US stocks is that we have all this information for free. For Australian market, for example, my home country, where I've managed investment portfolios on Australian stocks just as much as I have on US and other countries. But the Australian market doesn't provide all this information for free, so it makes it quite hard. Now, I'm just going to bring up a company, Apple, something that I've traded for nearly 20 years that has been a big money earner for many people. You can do look for a quote on Apple. It'll bring up some basic information about the company, not just your price activity, volume activity, but we then start to get some fundamental data out of that too. Now, as we scroll further down, you'll have headlines through the main body of the page, but on the right-hand side, we start to see some fundamental data. And all of a sudden, we can start evaluating the financials of the company. First of all, we've got earnings, and you can see here a green dot representing the actual earnings announcement, and the blue ring represents what that estimate had been, and it can show you whether they met, exceeded, or failed to meet the estimate from the previous meeting. Further down, we have the financials, revenue and earnings. Very simplistic and fundamental analysis here, but we're looking at the basic data of their revenue increasing in this case, and their earnings increasing as well. That's obviously a positive for a company, right? Very basic information though. As I scroll back up, I can actually click on financials, and this is going to give me the income statement, balance sheet, and cash flow of the company. Everything an accountant would need to evaluate the strength of a company. Of course, knowing how to read this is one of the key things. A bit beyond the scope of what we're here to do today, which is an introduction, but I just wanted to show you that you can get this information for free. The other thing is the trading platform that you use. If you're using reputable trading platforms, will most likely include analytics or fundamental data on that company as well. Finally, I have another website that I had previously brought up, and it's tradingeconomics.com. This particular website gives us all of the economic data for any country around the world. If I scroll a little further down here, sorry, just missed that cookie thing there. So here we have all the countries listed down on the left-hand side, and here are some of the key economic reports, the most important ones that typically define the state of the economy. GDP year on year, GDP is gross domestic product, GDP quarter on quarter, interest rates, inflation rate, jobless rate, government budget, debt to GDP ratio, current account currency, and the population. So these key economic reports here help us define what state is the economy in. Is it in a growth environment? Is it expanding? Is it contracting? Are we at a boom or a recession? All of these pieces of information help us define that. You can click on that country and then get a further list of even more economic reports. I won't go through the whole lot there. And you can also click on the particular economic report. It'll explain what that report shows you. It'll give you some history in that data, and you can get some other information as well as reports from other analysts. So for nothing at all, you can actually go and get this information and start to form an opinion. Of course, just with fundamental analysis, you need to learn how to read economic analysis to then make a decision on whether it's an environment worth buying or an environment worth selling. So I just wanted to touch on those key analytical techniques. Now, I mentioned before that markets and economies are geared for growth. I've already proved that with that long-term chart there of the S&P 500. Making a decision on whether you are looking for long-term performance versus short-term performance will be defined by many other factors. Some of that will be the capital that you have available, how much time you have available, what your expectations for return, and what is your level of risk tolerance. Are you someone that's very nervous about your money sitting in the markets? Are you someone that is a little bit more loose in terms of your risk level? You're willing to risk money in the markets for a shorter term gain. Now I use the S&P 500 as my benchmark for the US markets. There are other indexes as well. The Dow Jones Industrial Average is representative of the top 30 companies in the US markets. Whilst it is perceived as the key benchmark, to me the top 30 companies doesn't represent what I do in the market. So I use the S&P 500 along with the Russell 2000, which represents 2,000 companies, but small cap or the lower end of the market. So between those two, I'm getting a bit of a correlation between how investors are perceiving the more speculative smaller companies and how they're perceiving the bigger blue chip or what might be perceived as safer companies as well. So I touched on fear and greed. It's forever present in the markets. Now, learning how to read market sentiment will help you understand not only the market fear and greed, but you'll learn for yourself how your emotions play in terms of decision making as well. And one of the key indexes that you can use to help understand the fear and greed that's in the markets right now is the volatility index, or the VIX index. So I just want to jump into our trading platform, take a look at that. And I'll type in VIX. We'll bring up the index. So the other name for the VIX index is the investor fear gauge. And what does that mean? Well, what it means is that when the markets are falling, the VIX starts to rise. When the markets are trending upwards, the VIX really just trends along sideways. The market's in a state of positive growth and there isn't any fear out there. So one of the key things about using the VIX is that when the stock market goes up and the VIX starts to go up, there is this contradiction in amongst what we're seeing in terms of price activity and investor sentiment. And that is a warning signal. It's a point in time where I sit back and I take stock of where we are right at that point. Now, one of the other things to be aware of is that the VIX only starts to rise above certain levels when there has been a major movement to the downside. So normally we can see here during most of 2018 we've had an upwards market and the VIX has been hovering in around say 11 points, really up to about 17 in a few of those peaks. So during a nice bullish market, between 11 and say 13 points has been a pretty solid range for the VIX. So that shows there isn't any fear. As it starts popping above this 15 and 17 point level, something is happening in the markets. Usually you'll see that the markets is declining a bit. Now, normally a movement like that will define to me a point in time where I'm going to reduce exposure in the markets. So I'm no longer going to hold as many positions, or I'm going to reduce my position size, or I'm going to tighten up my exit approach. And so that's a methodology that I use in managing long-term as well as my short-term portfolios. Now, we had the S&P 500 up before. I'm going to bring up Apple actually. And what I want to do is I want to show you option volatility. So it's the same theory in behind this. So we have a volatility index here, which is derived from options, which is a secondary market. But the option implied volatility on the stock can give us a great deal of insight as well. First of all, ahead of a company's earnings, there is uncertainty on whether that company will meet, exceed, or fail to meet the earnings report that was previously stated. So there's a lot of uncertainty heading into that stock price, that stock announcement. So normally we'll see that the option implied volatility starts to rise. That's irrespective of whether the stock price is going up or down. Once that announcement has been made and there's certainty about how the company's performing, option implied volatility declines. And we see this almost on a quarterly basis. Now, when the stock market itself starts to fall or the stock price breaks its trend, we then start to see a higher option implied volatility. Now, as an options analyst and trader, something I've been doing for nearly 15 years in that market, that can give us a great deal of insight into what strategy we need to adopt. So it means that I can adopt a strategy where I can still be profitable as the stock price declines. I can be profitable if the stock price goes sideways, or I can make a decision on what to do if the stock price is rising. So it's just different strategies to go along with different methodologies. But volatility is one of the biggest insights into the market, whether it's the volatility on the stock price or it's something like the VIX index, and understanding how that VIX index correlates to the broader market. So this is like a bit of a window into the back end of the inner workings of the markets. Most people, the average investor and trader out there, does not know to look at the VIX index. It's such an amazing tool to help you with your decision making. The final point I wanted to discuss was that major downturns will occur in the future. They've happened in the past, they're going to happen again in the future. You need to know how to read the markets to be able to identify the types of signs that will occur when a major downturn is forming. Now, let me give you this one key tip. With every major stock market crash, and that's a different thing to a declining market or a bear market, with every major crash, there's been a downwards trending market prior. Now, first of all, stock market crashes do not occur at the top of the market. Now, I'm not talking about individual stocks here. I'm talking about the broader market itself. Stock market crashes do not occur at the top of a market. I'll use the 2008 GFC as an example. The peak of the markets was in the middle of 2007. The GFC, the global financial crisis, occurred in October of 2008. So the markets had been declining prior to that. And then this crash, this 10% movement over a couple of days, occurred in October 2008. So what that does is it means that if we know how to read the markets and know what signals to look for, how to analyze a trend, for example, and read the sentiment of the markets, then we'll have this insight that something is changing. We don't know what it's changing to, but something is changing, and we can manage our portfolio accordingly. Now, you need to have a plan for taking action. I don't get into any position without knowing what I'm going to do if it goes up, sideways, or down. And this is the biggest thing. Most people just focus on, I've spent all this time analyzing Apple, and Apple's the best company in the world, and they're the first $1 trillion company, and they've got great revenue, and they've got more cash than any country in the world. Apple's just going to be the best thing forever and ever. But if it doesn't meet those targets, if it goes down because of some other reason, and there's lawsuits for this or that, or they can no longer sell the iPhone in Europe, or the iPhone catches fire automatically when you press a button. Whatever that reason might be, and that company's no longer the darling of the markets. Well, you need to have a course of action to take, a plan. You need to have a plan for what action you're going to take when something analytically changes with that company. And finally, don't fear the markets. Don't fear whatever future crash is going to occur, because there will be a crash in the future. If you know how to read the markets, if you've got a plan, an action plan on what to do if something changes, A, with the markets, B, with the particular stock, then you don't need to fear a change in the markets or fear a declining market. And so this is where you need to build yourself towards. And it's partly mindset, it's partly knowledge, and it's partly skill or experience. So just as an example, I thought I'd grab this long-term chart of the S&P 500 Composite Index just to give you an idea that the broader markets increase over time. There are periods where we see a decline, whether that's sharply or whether that's just a short-term little glitch in the trend itself. The Great Depression that we saw back in the 20s and 30s, had a massive impact on economies. The GFC had a massive impact on economies, but in the grand scheme of things, it doesn't look as bad as what previous declines have been. There's been periods where the market's gone sideways, stagnated for quite some time. And so we will have all of these again in the future. Is knowing how to approach that will help you in making money in the markets. Some of the best trading I've ever had has been during the GFC when that market was declining. And I actually missed the actual crash of October 2008. I made profitable trades whilst the markets were declining through 2007 into 2008. The sideways market too can be difficult to trade. The uncertainty between whether it's going to eventually go up or go down means that we can adopt other types of strategies. That may need an understanding of things such as options or other derivatives to be able to be profitable during a sideways market, but not panicking and exiting trades that you otherwise could just hold on to if you're a long-term investor during a sideways market is also can be a far better decision-making process. So understanding that we will have a decline in the future, understanding that there will be a flash crash of some sort, there'll be something that occurs on one day and then everyone will be fine the next, that the markets are geared for growth economically as well as company fundamentals. Having that basis of an understanding of the markets means that now we can start to move forward and start to plan out how we're going to profit from the markets. So the key points I just want to touch on are that making money in the markets needs a plan. As you learn and develop the knowledge and skills, your plan will also grow. And don't get caught up in all of the noise that's out there. There's a lot of information now because of the internet, but we need to just focus on the key things that help us make decisions for entering, exiting, and managing our positions. So as you can imagine, it's almost impossible for me to show you everything that I've learned in 20 years and to provide you with a specific action plan to suit your personal needs, especially in such a short period of time. I've tried to cover as much as possible in building a framework for a broad audience so that you can see there's a simple path to managing how you approach the markets. In the end, the skills you need can be learned, and managing your emotions comes from guidance and experience. For those who need a step-by-step guidance to getting started in the markets, or if you're already active and not achieving results that you're looking for, you can learn more by registering your interest in the contact form below this email. Now, if you've come through the webinar to this point and thought, well, Matt, he's had some really good ideas, some valid points there. I've got most of that covered, so I don't think there's much else that I can get, then you're probably right. The fact is, though, that if you're not achieving results that you think you should be, then there's still work for you to do. It's hard for me to say what that might be, what needs improvement or adjustment, so just feel free to send me a message to discuss. So thank you for joining me in this introduction to trading and investing in the US markets. I hope it hasn't been too overwhelming. If it has, then you can watch the video again or feel free to drop me a line and ask some questions. Look forward to speaking to you all again soon. I wish you all the best in the markets, and bye for now.